The year is 2025. The stock market, that beast of greed and fear, is in free fall. Investors are staring at their screens aghast. Their portfolios, once brimming with digital gold, are shrinking faster than a polar ice cap. What went wrong? The answer, as with most things in life, is complicated. A perfect storm of factors has conspired to bring the market to its knees. This is not a time for panic, but for clear-headed analysis. We need to understand the forces at play, the triggers that set off this chain reaction. Only then can we hope to navigate the treacherous terrain of a bear market. So let's roll up our sleeves and delve into the messy, interconnected world of finance, geopolitics, and technological disruption. Buckle up, because it's going to be a bumpy ride. The first tremor, the one that sent that initial shiver through the markets, originated in China. DeepSeek AI, a company you might not have heard of until recently, launched its groundbreaking artificial intelligence platform on January 27th. The world, or at least the world of tech, took notice, and it didn't like what it saw. DeepSeek's AI, it turned out, was not just another incremental improvement, it was a leap forward, a quantum jump in machine learning capabilities. Suddenly, the dominance of American tech giants like Nvidia and Google seemed less assured. Investors, a skittish bunch at the best of times, hit the sell button. Nvidia's stock plummeted, shedding billions in market value in a single day. The Nasdaq, heavily weighted towards tech companies, followed suit. The DeepSeek shock exposed a fundamental weakness in the market: its over-reliance on a handful of tech behemoths. For years, the so-called Magnificent Seven, Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta, and Tesla, had been the darlings of Wall Street. Their soaring stock prices masked a dangerous concentration of risk. When one sector, even one as innovative as tech, becomes too dominant, the entire market becomes vulnerable. It's like building a house on a foundation of sand. The slightest tremor, the gentlest breeze of uncertainty, can bring the whole edifice crashing down, and that's exactly what happened. DeepSeek's arrival was the tremor, the breeze that exposed the fragility of the market's foundation. DeepSeek's triumph wasn't just a corporate victory, it was a geopolitical earthquake. The United States, used to its unchallenged supremacy in the tech world, suddenly had a serious competitor. And this competitor wasn't playing by the same rules. China's government, unlike its American counterpart, was deeply involved in fostering DeepSeek's rise. State-sponsored research, generous subsidies, and a more relaxed regulatory environment had all contributed to the company's success. The message was clear: the global balance of power was shifting. The United States could no longer take its technological edge for granted. This newfound competition, with its implications for national security and economic dominance, added another layer of anxiety to an already jittery market. Section 5. The Fed's Balancing Act: Inflation and Interest Rates. As if the tech turmoil and geopolitical tensions weren't enough, the Federal Reserve, America's central bank, decided to add its own special brand of uncertainty to the mix. Inflation, that insidious beast that erodes the value of money, had been stubbornly refusing to go away. The Fed's main weapon against inflation is interest rates. By raising rates, the Fed makes it more expensive to borrow money, which in theory should slow down the economy and bring inflation under control. But, raising rates too aggressively risks triggering a recession. It's a delicate balancing act, and in early 2025, the Fed seemed to have lost its footing. A series of hesitant, contradictory pronouncements from the Fed only served to further unsettle the markets. Investors, starved for clarity and reassurance, headed for the exits. Section 6. The consumer retreats, spending slows down. The stock market doesn't exist in a vacuum. It's ultimately driven by the real economy, by the goods and services that people buy and sell. And in early 2025, the signals from the real economy were flashing red. Consumer spending, the engine that drives the American economy, was sputtering. High inflation was eroding purchasing power, forcing consumers to cut back on discretionary spending. Retail sales were down, travel and leisure spending had plummeted, and even the once mighty housing market was showing signs of cooling. This slowdown in consumer spending had a ripple effect throughout the economy, hurting corporate profits and further depressing stock prices. Section 7. Uncle Sam's spending spree, debt and deficits loom. Adding to the economic anxiety was the precarious state of America's finances. The federal government, under pressure to provide pandemic relief and fund ambitious social programs, had been on a spending spree. The result? A ballooning national debt. A high level of government debt can crowd out private investment, push up interest rates, and ultimately lead to slower economic growth. While the United States had long been able to borrow cheaply thanks to its status as a safe haven for investors, the recent turmoil in the markets raised concerns about the sustainability of this model. Could the US government continue to finance its spending habits without triggering a fiscal crisis? The answer, at least to investors, seemed increasingly uncertain. Section 8. Storm clouds on the horizon, trade wars and black swans. As if all of this wasn't enough, there were other, more unpredictable threats lurking on the horizon. The trade war with China, reignited by the former president's return to the political scene, threatened to disrupt global supply chains and further stoke inflation. And then there were the black swan events, those unforeseen and highly improbable occurrences that can have a catastrophic impact. A global pandemic, a natural disaster, a cyber attack on a major financial institution, any one of these events could send the already fragile market into a tailspin. While it's impossible to predict when or if such events will occur, their very possibility added to the sense of unease and uncertainty that pervaded the markets. Section 9. Weathering the storm expert advice for investors. So, what's an investor to do in these turbulent times? The first piece of advice from most experts is, don't panic. Market corrections, even sharp ones, are a normal part of the economic cycle. What goes down must eventually come up, at least in the long run. Legendary investor Warren Buffett, famous for his calm demeanor and long-term investment approach, has been saying for years that the best time to buy is when there's blood in the streets. While this might seem counterintuitive, the logic is simple. When prices are depressed, you're buying assets on sale. Of course, timing the market is notoriously difficult. No one, not even Warren Buffett, knows for sure when the market has hit bottom. But for investors with a long-term horizon, the current downturn may present an opportunity to buy quality companies at discounted prices. The key is to stay disciplined, avoid emotional decisions, and remember that the stock market is a marathon, not a sprint. Buckle up, the ride might be bumpy for a while, but eventually the storm will pass and the sun will shine again on Wall Street.